At first glance, silver and gold are often grouped together. They're both called precious metals, both seen as stores of value, and both tend to attract attention during times of economic uncertainty. But in this cycle, something unusual is happening. Silver is not behaving the way most people expect it to, especially when compared to gold. And that difference is not random. It's structural. To understand what's happening, you have to let go of the idea that silver is simply a cheaper version of gold. That assumption worked in past cycles. But it breaks down completely in the environment we're in now. Silver sits at the intersection of two very different worlds. On one side, it functions as a monetary metal, responding to currency instability, debt expansion, and declining confidence in financial systems. On the other side, it is a critical industrial input deeply embedded in modern infrastructure, technology, and energy systems. Gold, by contrast, is much more singular in its role. It reacts primarily to monetary stress, real interest rates, currency confidence, and central bank behavior. When gold moves, it is usually sending a signal about trust in the system. Silver moves for those reasons too, but it also responds to something else entirely: physical demand that cannot be deferred or substituted easily. This is why silver's reactions often appear delayed, muted, or even confusing when viewed through the same lens as gold. Investors expect silver to mirror gold's movements immediately, but silver is constantly balancing to forces that pull in different directions. Monetary stress pushes it higher, while industrial cycles, supply constraints, and physical availability introduce friction and volatility. In this cycle, that tension has intensified. Industrial demand for silver has not weakened in the way it typically does during slowdowns. In fact, in many areas, it has increased. Energy transition technologies, electrification, and digital infrastructure all rely heavily on silver. Unlike discretionary demand, this usage is not easily turned off when economic growth slows. That creates a baseline level of demand that didn't exist to the same degree in earlier cycles. At the same time, supply growth has failed to keep up. Silver is rarely mined on its own. It is usually produced as a byproduct of other metals, which means supply cannot simply be ramped up in response to higher prices. This creates a structural rigidity that gold does not face in the same way. Gold supply responds more directly to price incentives. Silver supply does not. This combination changes how silver behaves. Gold can move cleanly on monetary signals. Silver absorbs those signals, but they pass through layers of physical constraint, industrial necessity, and supply inflexibility. The result is a metal that often looks sluggish at first, then suddenly reacts sharply when pressure builds beyond a certain threshold. Another important difference lies in how the two markets are structured. The gold market is dominated by central banks, institutional reserves, and long-established storage mechanisms. Silver, on the other hand, has a much smaller above-ground inventory relative to its annual consumption. Large portions of silver are consumed permanently in industrial processes, while gold largely remains in vaults and can re-enter the market. That distinction matters more than most people realize. When demand increases for gold, the market can often draw from existing reserves. When demand increases for silver, there is far less flexibility. Physical availability becomes a real constraint, not just a pricing variable. This is one of the reasons silver can stay undervalued for long periods and then reprice violently. What we are seeing now is the early stage of that dynamic. Gold is responding first, as it usually does, reflecting growing stress in currencies and financial systems. Silver is reacting differently because it is still being pulled in multiple directions at once. But that does not mean silver is lagging in importance. It means it is storing pressure. And pressure in markets like this does not dissipate quietly. To understand where this divergence leads, it helps to look at how similar cycles have resolved in the past. Historically, gold tends to move first. It responds to shifts in monetary policy, changes in real interest rates, and declining confidence in fiat systems. Silver usually follows later, but when it does, it often moves with far greater intensity. This isn't coincidence. It's the result of the pressure that builds quietly while attention remains focused elsewhere. During the early phase of a cycle, silver often appears frustrating. It underperforms gold, trades sideways, or reacts inconsistently to macro signals. This leads many investors to lose patience or dismiss it entirely. But this phase is not weakness. It is compression. Silver is absorbing conflicting forces, monetary demand pulling upward, industrial usage anchoring supply, and market structure limiting flexibility. As this compression continues, the market becomes increasingly sensitive to small changes. A modest shift in investment demand, a disruption in supply, or a change in perception can suddenly overwhelm the system. When that happens, silver doesn't drift higher. It revalues. This is where silver's behavior diverges most sharply from gold. Gold's market is deep and liquid. Large participants can enter and exit without significantly disrupting supply. Silver's market is much thinner. When investment flows increase meaningfully, they compete directly with industrial demand for a limited physical pool. That competition creates instability, and instability leads to rapid price adjustment. Another factor often overlooked is how silver is treated in portfolio construction. Gold is widely accepted as a monetary reserve asset. It has an established role in central bank holdings and institutional portfolios. Silver does not. That exclusion keeps silver underallocated for long periods. But it also means that when sentiment shifts and silver is reconsidered as a strategic asset, the reallocation effect can be outsized. In this cycle, there are early signs of that reassessment. Investors are beginning to question whether traditional hedges are sufficient. Currency volatility, persistent debt expansion, and geopolitical fragmentation are forcing a broader evaluation of real assets. Gold benefits first from this shift, but silver becomes increasingly relevant as affordability, physical utility, and scarcity intersect. There is also an important psychological component. Gold is seen as conservative, stable, and protective. Silver is seen as volatile and speculative. That perception discourages early positioning and delays broad participation. But once silver begins to move decisively, that same volatility becomes a magnet. Momentum builds quickly, and positioning shifts rapidly as investors try to catch up. This is why silver's strongest moves often occur when few are expecting them. By the time consensus forms, much of the move is already underway. The transition from indifference to urgency happens fast, especially when physical availability becomes part of the narrative. Delivery delays, rising premiums, and inventory tightness change behavior more effectively than charts ever could. It's also important to recognize that silver's industrial role amplifies this dynamic. Industrial users cannot simply step aside when prices rise. They must secure supply to maintain operations. This creates a non-negotiable layer of demand that interacts with investment flows in unpredictable ways. Gold does not face this pressure. Its demand is almost entirely discretionary. As this cycle progresses, the divergence between gold and silver is likely to become more pronounced before it resolves. Gold will continue to reflect monetary stress and system confidence. Silver will continue to oscillate between its monetary and industrial identities. But that oscillation is not noise. It is the mechanism through which pressure accumulates. When that pressure reaches a critical level, silver's reaction tends to be swift and difficult to control. Market participants who rely on gradual models or linear assumptions are often caught off guard. Those who understand the structural differences between silver and gold are better prepared for how this cycle may unfold. What matters now is not short-term price movement, but context. Silver's behavior is telling a different story than gold's, not because it is weaker, but because it is constrained. And constrained systems rarely adjust smoothly. As this cycle moves closer to resolution, the signals that matter most are not always visible in headline prices. Silver rarely announces its shift in advance. Instead, the change begins at the edges of the market, where physical availability, delivery terms, and participant behavior start to diverge from what paper prices suggest. This is often the first indication that the system is under stress. One of the earliest confirmations tends to be a change in how silver responds to negative news. In earlier phases, silver often sells off alongside risk assets, even when macro conditions appear supportive. But as the cycle matures, that relationship weakens. Silver becomes less responsive to broad market sell-offs and more sensitive to supply constraints and localized demand pressure. This is not sentiment-driven movement. It is structural. Another signal appears in the relationship between spot prices and physical premiums. When paper prices stagnate or decline, while premiums remain firm or rise, it suggests that the quoted price is no longer fully reflecting real-world conditions. This disconnect can persist for some time, but it rarely resolves quietly. Eventually, the imbalance forces a repricing event. Investor positioning also begins to shift in subtle ways. Early adopters tend to focus on accumulation rather than speculation. They prioritize physical access and long-term exposure over short-term trades. This behavior reduces available supply without immediately impacting visible metrics, creating an illusion of stability that masks growing fragility. At the same time, industrial demand continues in the background, largely unaffected by price narratives. Manufacturers are not trying to time the market. They are securing inputs. When availability becomes uncertain, their priority shifts from cost optimization to continuity. That shift tightens the market further and reduces flexibility precisely when investment demand begins to reemerge. This is where timing becomes critical. Silver does not offer many clean entry points once momentum builds. The transition from undervalued to aggressively bid can happen over a relatively short window. By the time the move is widely acknowledged, access becomes more difficult and risk increases. This is why silver tends to reward preparation rather than reaction. It's also why comparisons to gold can be misleading at this stage. Gold provides confirmation of monetary stress. Silver provides acceleration. The two metals are connected, but they do not move in sync. Gold validates the environment. Silver expresses it. In previous cycles, silver's most significant advances occurred after long periods of apparent inactivity. Those periods conditioned market participants to expect continued underperformance. When conditions finally forced adjustment, positioning was thin and conviction was low. That combination amplified volatility and compressed timelines. In the current environment, many of those ingredients are already present. Debt levels remain elevated. Monetary policy credibility is strained. Supply chains are more fragile than they appear. Silver sits at the intersection of these pressures, absorbing them quietly while attention remains focused elsewhere. This does not mean outcomes are guaranteed or timelines are predictable. Silver is not a straight-line trade. It is a pressure-driven asset. Its behavior reflects constraint, not consensus. Understanding that distinction is essential. The key takeaway is not that silver must outperform gold, but that it reacts to different triggers. Gold responds to confidence. Silver responds to stress. When stress accumulates beyond what the system can absorb, silver's response tends to be abrupt. For those watching closely, the question is not whether silver will move, but whether the market will recognize the transition in time. By the time the story becomes obvious, the dynamics have usually already changed. Silver reacts differently because it is positioned differently. And in this cycle, that difference may matter more than many expect.